Subscribers to the Finance Fundamentals channel are from all over the world, with the top 6 countries shown here. This makes sense because most of the time I deal with topics that are independent of international boundaries. But this video is different. I get quite deep into the weeds about aspects of South African tax law, specifically as it applies to older taxpayers. But many other countries, including the ones shown on the screen right now, have similar tax advantages for the over 65s. So stick around, you might discover valuable tax savings wherever you are from. In South Africa, the tax year runs from the beginning of March to the end of February in the following calendar year. We will use the example of a tax year that begins on 1 March 2025 and ends on 28 February 2026. If you are in the situation that you turn 65 anywhere between those two dates, even if you turn 65 exactly on the 28th of February 2026, then a number of tax advantages are available to you. The 3 main ones are that your monthly pay-as-you-earn deduction goes down, which will mean that your monthly take-home pay increases. Secondly, the tax benefit of your medical costs goes up substantially. And finally, your exempt interest income also goes up. Those advantages are available to you simply because you turn 65 in that date range. You do not have to be officially retired to obtain those tax advantages. You can still be working. It is simply a function of your age, not your employment or retirement status. Just to be clear about the timing of the tax advantages that I'm going to be talking about in this video, if, for example, you are aged 63 and you are watching this video in December 2024, you may be thinking, well, I'm 63, I don't even turn 65 next year. That happens only the year after next in, for example, January 2026. You may think, this is a long way away. And that is quite wrong. Because of the structure of this part of South African tax law, as I mentioned a moment ago, if you turn 65 anywhere within a particular tax year, these advantages begin for you at the start of the tax year. So in this example, you may well be age 63 in December 2024, but it is less than 3 months before your tax status changes for the better at the beginning of March in 2025. And because I don't want this video to become irrelevant earlier than necessary, the principles I talk about here are fairly time independent. You may, for example, be watching this video age 63 in December 2025, and that places you then in a situation in which those tax advantages arrive perhaps sooner than you think, which is a good thing, and they will be taken into account in your tax assessment for the tax year beginning on the 1st of March 2026 and ending in February 2027. As at the date of producing this video, I have no idea what future tax rates will be. So just for the purposes of setting up my illustrative examples in this video, we will be using the tax tables for the 2025 year of assessment. If you're watching this video in 2026 or 2027 or some future date, don't click away. I'll be giving some guidance in a moment about how to locate the relevant information for whatever future year applies to you at the date that you watch the video. The first of the 3 benefits for being 65 or older is a monthly PAYE decrease related to something called the secondary rebate, which is highlighted on the screen. That amounts to a reduction in your tax liability of, for the year, 9,444 Rand. And divided by 12, that becomes an amount of 787 Rand per month, which directly results in an increase in your net take-home pay. This 787 Rand per month increase in pay is the same for all taxpayers, whichever marginal rate, putting that another way, whichever one of those taxable income bands that you fall into, that 787 Rand per month is calculated as a reduction of your tax liability and therefore is independent of your marginal tax rate. So it is exactly the same for everyone who is 65 and older. I said a moment ago that I would give some assistance if you are watching this video in future years. For example, you need the information for the 2026 tax year. The trick there is to remember that this thing is called the secondary tax rebate, and my suggested Google search term is there. Next up, we have the medical expenses tax credit for taxpayers age 65 and older. The calculations here are, to put it mildly, somewhat convoluted. Thankfully, SARS does provide us with an example, but unfortunately that example is somewhat dated, applying to the 2014-2015 year of assessment. So what I've done in this video is take this example and updated it for 2025. We have the following changes from the original example. The tax credit is now 364 Rand per person per month, not 257 as it appears in the original example. And then for the various medical expenses going into that calculation, I've assumed a medical inflation rate of 10% per annum over 10 years, which means that the 24,000 Rand contribution to the medical aid is now 62,200 Rand in 2025, and the 20,000 Rand qualifying medical expenses for the original 2015 example are now 51,900 Rand. And here is how it works. We start with the so-called Section 6A credit calculation. Here we have the taxpayer and their spouse, so it's two adults, and the credit is 364 Rand per person per month. So that calculation of the Section 6A tax credit is 364 Rand plus 364 times 12 for a total of 8,736 Rand. Next, we calculate the additional medical expenses tax credit, the so-called Section 6B credit. We begin here by calculating the total contributions paid to the medical scheme less 3 times the medical scheme fees tax credit. I told you the calculation was convoluted, but here we have assumed that the 2025 amount is 62,200 for the total contributions paid to the medical scheme, and then we take the amount previously calculated for Section 6A, multiply that by 3, deduct that from the 62,200 to get to an amount of 35,992. Next, we add to that the qualifying medical expenses paid. In adjusting the original example from the 20,000 Rand paid in 2014-2015, we have increased that to a 2025 amount of 51,900 Rand. and that is then inserted into the Section 6B calculation. We get to a subtotal of 87,892 Rand, and then finally, for this part of the calculation, we take 33.3% of that subtotal. And in researching for this video, I've seen and read commentators get quite excited about the fact that the calculation here is not 1/3, and they seem to be quite exercised about this, that in fact you need to multiply your subtotal by 33.3% and not divide that amount by 3. So they're very specific about that. So we will accordingly follow the instructions carefully and multiply the 87,892 by 33.3% to get to 29,268 Rand. That amount then is taken into our column on the right-hand side as the Section 6B credit. And the final step is simply to add the Section 6A credit of 8,736 to the Section 6B credit just calculated, for a total reduction in the taxpayer's 2025 tax liability of 38,004 Rand. And here it's important to stress that this is not a deduction. This is in fact similar to an additional rebate. This is a direct reduction of the taxpayer's tax liability. All else being equal, they will receive a refund at the end of the tax year. Not quite at the end of the tax year. There is a delay. You need to complete the tax return, and SARS has to issue your assessment, and you need to deal with any queries. But all else being equal, that will turn up as a 38,004 Rand refund for this particular taxpayer. So it is not a monthly benefit receivable by the taxpayer. It is a lump sum which follows with some delay the tax year to which it applies, but still a very nice benefit to have, and by far the biggest of the three that we are going to discuss in this video. What amounts are regarded as qualifying medical expenses? It is pretty self-explanatory. Once again, that is guidance that I've obtained from the SARS website. I think the one that is perhaps worth emphasizing is that it is only prescribed medicines. You can't claim over-the-counter pills and potions under this particular part of the tax code. It has to be prescription medication. The other thing to be careful and aware of, I think, is what paperwork is needed. And this is something that might, on the face of it, appear to be quite onerous. You need to be quite careful that you are ready for any queries, any audits that come from SARS about this. But I've spoken to family members, so yeah, take that with a pinch of salt. It's anecdotal evidence, but in essence, it seems to be the case that in general, and once again, please just don't take my word for it, check with your financial or tax advisor about this. But as long as you channel all of your medical payments through your medical scheme, through your medical aid, you will get a certificate from them at the end of the year of assessment, which I have been given to understand is generally accepted by SARS, and you will not be asked for additional primary evidence of your expenditures. But just in case, it seems to be advisable that you would need to just keep hold of your receipts. The third and last of the tax benefits for older taxpayers that I discuss in this video is the exempt interest income allowance. This is the smallest of the three benefits discussed here, and unlike the other two, this one depends on your tax bracket or your marginal rate. I've given examples there of the potential tax savings for taxpayers at a 31%, 39%, and 45% marginal rate. As you can see, all of those numbers are substantially smaller than the benefits discussed earlier. A final note about this one is that you should most certainly not automatically reallocate your investment portfolio simply to capture the interest income tax savings. That would be not advisable at all. The tax exemption is just one factor among many that you should consider in your asset allocation process. So this one, yes, it is small, but it might be worthwhile capturing, but it is certainly not the only thing that you would take into account. And that is it. If you made it this far, thanks very much for watching. I hope you found the video interesting and useful. And if you have any questions, leave them in the comments section. I'll be happy to try and answer them. But as always, with this kind of thing, you should first and foremost be talking to your financial advisor or your tax professional about these things.